one like Bank OZK and Valley tend to skew a little bit more commercial real estate. So not that we're necessarily concerned, but I think that does require additional scrutiny into the details of portfolios in this environment.
Bank OZK, by the way, up about 1% in today's trade. New York Community Bancorp, though, down another 6%. It rallied about 6% yesterday, but losing some ground today. Cheryl Pate, Senior Portfolio Manager at Angel Oak Capital, on Zoom from Atlanta. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got chip designer ARM Holdings surging after the company issued a surprisingly bullish earnings forecast, showing its push beyond smartphones is helping fuel growth. CEO Rene Haas spoke this morning with Bloomberg Radio.
We believe that AI is the most profound opportunity in our lifetimes, and we are only at the beginning. When you think about artificial general intelligence and what is required to make that happen in terms of compute, power efficiency, energy, those are all great areas for us to be involved in and focusing in. So I think AI is not in any way, shape, or form a hype cycle. I think we're in incredibly early days, and I think it's going to have amazing impact on our planet.
ARM said revenue in the 3 months ending in March will be $850 million to $900 million, far surpassing analyst projections of $778 million. ARM shares surging today. Again, right now they are up by 48%. After earnings, shares of the Walt Disney Company are also pushing higher. We've got Disney today up by 11.3%. And among the names coming up after the close of trading, minutes from now, we will be hearing from both Cloudflare and VeriSign. Alphabet's Google has rebranded its chatbot and rolled out a new subscription plan that will give people access to its most powerful artificial intelligence model, placing it squarely in competition with rival OpenAI. Citigroup is weighing a move to cut 51 roles across its wealth division business in London as the division's new chief looks for ways to boost the returns generated by the unit. S&P at 49.92. Those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week, and February is Black History Month. And every day this month, we are celebrating significant moments in U.S. Black history. Now with your installment for February 8th, here's Bloomberg's Justin Milliner.
Tim, thank you very much. On this day in Black history in 1944, American journalist Harry McAlpin became the first black reporter to attend a U.S. presidential news conference. Born in 1906, McAlpin studied journalism at the University of Wisconsin. Right after getting his degree, he moved to Washington, D.C., and got a job doing a little bit of everything for the Washington Tribune. McAlpin even attended law school at night, passing the D.C. bar exam in 1937. That is a lot of hard work, and eventually it paid off. When the National Negro Publishers Association was able to get White House press credentials, they tapped McAlpin to be the first full-time Washington correspondent in their new D.C. bureau. His barrier-breaking appearance in the White House takes us to today, where Karine Jean-Pierre serves as the first black White House press secretary.
Being in this room, being in this building is not about one person. It's about, what we do on behalf of the American people. Clearly, the president believes in representation matters, and I appreciate him giving me this opportunity.
That's Karine Jean-Pierre at her first press briefing, and that is today in Black History. Carol and Tim.
Pretty cool stuff, right?
Very cool stuff. Yeah, absolutely.
I was going to say, though, I was thinking about Karine being the first Black White House. It took that long. That it took that long. Part of me was kind of like, it should have come a lot sooner.
Yeah, and that, I'm finding it a lot as I do research for these. It's funny how
it's your lifetime that this is happening.
Yes, it's my lifetime, and very recently that this has happened. We had a black president before we had a first black press secretary.
But look, we see this with representation everywhere. We talk about it all the time on our program when it comes to executives at publicly traded companies. The diversity, no matter how much they talk about it, it's just not there.
It isn't there, and it's tough to work on it. There's a lot of tiers in where the problems are. Of course, you have companies working on bringing more people into the mix, but they're bringing them into entry-level roles.
Exactly.
Then we have to figure out a way how to elevate those people. What can we do to, once you're in the building, how do we work with you? How do we get you promoted into the higher ranks of the business? And that's something I think more recently we're struggling with. After 2020, there's been a big push to get more people in the door. Now let's elevate them in the company.
Yeah, entry level got that one down, but let's move them through the pipeline and move them up along the pipeline. All right, Justin Miller, thank you so much. All right, to the markets and beyond the bell. It's time.
Did we get to that 5,000 level? No. 4998.52 is the early read, but of course we're waiting for it to settle. We're going to come shy of that 5,000 level. It is a gain of almost 0.1%. Dow Industrials adding about the same amount, and Nasdaq gaining 0.25%.
All right, folks, let's get to some earnings crossing the Bloomberg terminal. We're talking about Expedia, home to so many travel websites. Man, getting killed in the aftermarket, down about 8.5%. Let's go to the numbers. Fourth quarter revenue, 2.89 billion, slightly higher than the street estimate of 2.88 billion. Fourth quarter adjusted EPS $1.72. That's 3 pennies better than the street was expecting. Fourth quarter negative free cash flow 415 million. The estimate was for a negative 192.6 million. So that's going to disappoint investors. Fourth quarter gross bookings 21.67 billion. And Tim, that's also coming in light. 22 billion was the estimate. Stock down about 7.8% here.
Yeah, Peter Kern, the vice chairman and CEO of Expedia, saying our work is finally starting to deliver results, and we are in the best place we've ever been technologically. Moving forward, we are now able to execute without the numerous constraints we have faced in recent years. We will continue to focus on acquiring and retaining the right customers, driving share growth in our B2C and B2B businesses, and providing the best product and partner experience in the industry. And
Expedia also announcing a CEO transition plan and pause. Two other really interesting things. One, ARM adds $38 billion in value,
That's
a
real
record
money.
48% jump. And the S&P briefly broke above 5,000, guys. It didn't settle there, but it briefly broke above that for the first time ever.
Really?
Yeah, there should be balloons and confetti.
5,000.40.
We did
This is true. Yeah, but
it's a touch and go, right? Like that's all
it doesn't count though if it was intraday. Like we only count it when it's the close, right? You break out the hats when it closes above that level.
There's options tomorrow. It's going to move.
All right. We'll see whether
was this
we
one
get
of your
some
gainers,
momentum.
Carol?
Yeah. Okay. No. Let's get to some of the individual gainers. Surprise, surprise. ARM Holdings was a gainer, soaring to a record, up the most since its IPO last September. You know the news. You know the story. The company issued a surprisingly bullish earnings forecast, showing, and we've all had conversations about that, pushing beyond smartphones is helping fuel growth. So that was certainly a big, outstanding name. Another chip name on my radar, and this is Monolithic Power, say that 5 times fast, among the top of the NASDAQ 100. It's a semiconductor device company, reported fourth quarter results, beat expectations. It also gave a positive outlook. Analysts noted a tailwind from artificial intelligence. You had a lot of analysts raising their price. KeyBank, Cowen, Oppenheimer, Truist, all raising their price targets. KeyBank with a street high now of $8.30 a share, boosting it from a previous target of $600. But again, the stock up 47% by the close here. And then Disney, had to talk about it, rallying big time, most intraday, or most in about 3 years since December of 2020. You know the story there, reported better than expected earnings for its fiscal first quarter, raised its dividend 50%, approved a $3 billion stock buyback plan, and issued an upbeat profit outlook for the year. So again, that one was up more than 11% in today's trade.
All right, well, let's look at some of the decliners as we continue to wait on earnings. Let's start with PayPal, among the worst performers on a percentage base in the S&P 500, sinking more than 11%, the most in months. This after the company issued a disappointing 2024 outlook. PayPal said it expects earnings to be flat this year as it continues to cut costs and streamline operations. Just a reminder, the company did announce last month it's going to cut about 9% of its workforce, part of the CEO's efforts to boost profits. Taking a look at Snap-on Tools, following the most intraday since March of 2020 after the company's tools group reported a sales shortfall. Management did say the segment's performance was, quote, not at our standard. Shares finishing down by 9.7%. And then, have you guys been talking about 23andMe much? The stock has been under a ton of pressure.
Tim has been talking about
it a lot.
There,
right?
It's barely there. I mean, there are concerns that it's going to get delisted. Shares today falling for yet another day. The company CEO, Ann Wojcicki, telling Bloomberg News that she's considering splitting up the DNA testing company's consumer and therapeutics businesses in an effort to revive a sagging stock price and avoid being delisted, down another 13% today. Total return on the stock has been decline of more than 90%.
Have you guys taken one of those 23andMe tests? I mean,
No,
I feel
but
like everyone who was going to did it a few years ago.
That's exactly the problem, right? It's not a recurring revenue business.
But they keep adding more people to the database. So then you can keep going back. So I haven't done it, but my husband does. He's totally into it. So he loves the whole, let's go back and then see if they've added more people.
But does he pay each time he goes back?
He doesn't tell me me these things.
I do wonder, let's say the company is delisted, that's split up. I wonder what happens to the data, because a big question that I have is about the privacy of this data.
This is why I don't do it, because I don't want to share this information.
Yeah, that's a question that I have.
They already have all the data, please, from your smartphone. Anyway.
Stop.
Right? And just to pick a quick pivot here on yields, because we did see yields climb. We had that successful 30-year auction, but yields moved higher. We had a little bit of a sell-off, but not at all affecting the equity market. It does feel like we can have higher yields now and a higher equity market.
Yeah, it's kind of a ho-hum day in treasuries. I'm accustomed to seeing 23 basis point moves. So that's kind of shocking in how slow and boring it is. We have Take-Two numbers coming out. And Take-Two, of course, the video game publisher, everyone cares about it because of Grand Theft Auto 6 when that does come out. Not a whole lot of numbers to work on right now, but third quarter net bookings of $1.34 billion, slightly higher than what was anticipated, which was $1.32 billion. We're waiting for some more numbers to cross right now, but if you look at how the stock is trading in after hours, we have it closing up 3 cents at 169.60.
Up about 1%.
Like it's moving higher, right?
Yeah, it's just moved up a little bit right here. Yeah, this is a stock that I'm just looking at. It's up about 5% here so far this year, but again, you're seeing a little bit of momentum, up 2.5%. The company's saying it sees fiscal year net bookings of 5.25 to 5.30 billion. The estimate on the street, this looks a little light, 5.44 billion. And again, third quarter net bookings coming in at 1.34, a little bit above that estimate, Tim, of 1.32.
Yeah, shares of Pinterest, I want to go to those. They're getting crushed in the aftermarket right now, down more than 19%, down 20%. Fourth quarter adjusted earnings per share did beat estimates, coming in at 53 cents versus 48 cents. Fourth quarter revenue coming in below estimates, 981.3 million versus 990.2 million. Adjusted EBITDA coming in just above estimates, 364.8 million. Estimates are for 358.4 million.
I mean, they're looking for the first quarter of 2024, though, to be about 15 to 17% growth year over year, but that's kind of doing nothing for investors right now.
I feel like we got a sense that this was coming after Snap's results, which weren't that great either. And the kind of move that we're seeing in Pinterest kind of mimics what we saw in Snap.
Like, I'll go to Pinterest, but I'm not going to buy anything on Pinterest.
It's becoming a tale of like two different types of companies, right? You have the Alphabets and the Meta platforms that are just dominating when it comes to social, when it comes to advertising, I should say. And then the ones that are the challengers, the Snaps and the Pinterest.
The big get bigger.
Yeah.
Right? Let's go to Affirm. That's a fun company to watch. It's a buy now, pay later. So Affirm, the one you want to pay attention to is their gross merchandise volume, and this is for the third quarter. That's how they do their fiscal year. That's coming in at the high end of $6 billion. The estimate was for $5.89 billion, so a bit better than estimates. They see third quarter revenue on the high end, pretty good, coming in at $550 million. That stock, though, down by about 13%. Have to sort of dig into a little bit of why
it's now down
there.
about 20%. I'm trying to look through here on the press release, but that is pretty remarkable. As you said, second quarter revenue, $591. That looks better than the street was expecting. Looking at the outlook, sees third quarter gross merchandise volume of 5.8 to 6 billion. The street estimate was 5.89. So there's got to be something here that is making investors kind of run for cover because it's down about 20%.
Yeah, the quarter that ended, the second quarter, revenue blew out expectations, $591 million versus the expected $520.7 million. So that's curious. We'll have to dig into that a little bit more. I guess people's expectations were just much, much higher than what we actually saw.
Yeah, a lot of stocks on the move, though. Affirm down 16% in the aftermarket. Expedia down 13% in the aftermarket. So we'll continue to track them here and look for some commentary on some of those calls. All right, guys, that's a wrap. A busy one across platform radio, TV, YouTube, and Bloomberg Originals. We will see you again, same time tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody. Sorry, a little bit of a busy day. Some earnings, they continue to cross, so we'll keep a track on it as they cross the Bloomberg terminal. Having said that, one of the things that we did notice was Apollo Global Management shares trading higher today. This is after the company posted record annual earnings, beat Wall Street estimates as higher interest rates powered growth at the credit-focused alternative asset manager.
Apollo, though, took a more muted tone than some of its peers on the prospect for private equity exits. Principal investing income from selling private equity assets will fall below the multi-year average leverage target of $1 per share in 2024. That's according to CFO Martin Kelly, who said that on the earnings call.
All right, one company. We wanted to zoom out, though, for an update on all things private equity. And for that, we turn to Antoine Dreen, founder and chairman of Triago. It's a placement agent best known for assisting private equity firms with fundraising. And since 1992, the company has raised and advised clients in more than $50 billion in capital. We're getting that from its website. But we've got the man here in studio, here in our Bloomberg Interactive Broker studio. Antoine, nice to have you here. How are you? Let's start big and broad, though. How does the environment look this year when it comes to private equity?
We are going back to reality, right? After QE, zero interest rates, et cetera, we're going back to flight to quality, mostly. Mm-hmm. It's obviously tougher out there. It's tougher for exits, as you've been saying. It's also tougher on the investment side because credit is lacking. So we are, I think, going to what private equity was in the early 90s, right? Adding value to businesses and being smart about investing.
Discrete, discretionary?
Of course.
Yeah.
So does private equity thrive in an environment like that?
Not all of it. Some of it was just, riding the wave, I guess. And these guys are in trouble because things are now tougher. For those who know their way within the difficult environments, it's obviously great times. They can buy great assets at cheaper prices. Mm-hmm. They can have less competition, and they can think about great growth plans.
How are you thinking about using leverage when it comes to buyouts right now? Just because interest rates are so much higher.
I think it's obviously part of the game. Leverage can make people rich. It can also hurt or kill. I think you have to use it with a lot of skill, and that's what most of these guys are doing right now.
What do you make of, though, it's all about private credit right now? Do we continue to see, I feel like, traditional Wall Street is saying, wait, I increasingly want a piece of that. How does that impact the market? How does that, impact some of the conversations that you're having with the clients you deal with?
Most LPs are indeed interested in credit. You go to them, they don't really want to know about private equity, nor VC growth, et cetera. They're all interested in credit. I guess up to a point. At some point, there will be probably too much available, and
money chasing too many things, or not enough things.
Of course, right? And like everything, it's supply and demand. And when there's too much supply and not enough demand, you're in trouble.
Does it? When you say trouble, though, does it mean that it results in that we see assets being bid up in terms of valuations, and so there's going to be fallout as a result?
Yeah, and it's going to mean less. Performance is probably going to be hit. I think it's not there yet, right? There's going to be a few years where the asset class is going to thrive, but at some point, things go back to the mean.
Hey, we should know, for everybody who has not necessarily been keeping up, Houlihan Lokey is acquiring Triago. The deal is expected to close in the first half of the year. What does this look like for your life? What does it look like for the business? This is a big deal.
Do you go on vacation? You said good.
I'm not yet going.
I'm
not yet going on vacation. The deal is not closed yet. We have signed an agreement. We are basically done, except that we're waiting for regulatory approvals. So we should be done, as you said, in the next month. For the time being, we operate as two different businesses. But at some point, yes, we will become part of a big machine, which is great for us. Lots of new opportunities in this huge market.
Can you give us some details of the agreement? Purchase price?
Can I say no?
You can say whatever you want. That's the secret to these interviews.
I'm afraid this is still something we are not talking about. Maybe when the deal is done, maybe. That's also something they need to agree to.
Maybe you could tell us what the tie-up of these two companies means for your business.
It means it's really 1 + 1 = 3, maybe more. Our strengths are their weaknesses. Their weaknesses